Welcome back. It's quite amazing how much content we have already covered. The course started by explaining why you should invest in the first place, and now, after just a couple of hours, you are already analyzing stocks in detail. Well done! Today's lesson will answer two of the most fundamental questions of investing: when to buy and when to sell. If someone wakes you up in the middle of the night and asks you these questions, you should be able to answer them straight away. You can get angry at the person who woke you up afterwards. As we shall see in this lesson, the optimal moment to purchase or sell a stock has little to do with timing and more to do with the stock price in relation to value. Let me explain. Everybody knows that you should buy low and sell high if you want to make money on the stock market. However, in the beginning of this course we discussed that many investors actually fail to do this and that this is disastrous for their returns. So what is wrong with their timing? Well, the problem actually lies in the word timing. I have mentioned several times already that short-term price movements are impossible to predict because these fluctuations in price are largely determined by emotional rather than rational investment decisions. Therefore, timing the market is impossible. There is simply no way to exactly know when a stock price has hit its bottom or its peak. People who tell you otherwise are either lying or have been really lucky a few times. Remember that even a broken clock is right twice a day. So if it is impossible to know when a stock price has hit its bottom, how can you possibly know when to buy? Well, the thing is that you don't have to know when a stock has hit its bottom. You can earn amazing returns without ever buying a stock at its lowest price. Of course, you are trying to buy a stock as low as possible. But do not fool yourself in believing that you know when it will reach its bottom. Again, it is impossible to time the market. However, it is crucial that you buy stocks at a low price, because not just the business performance, but your purchase price largely determines your returns. Or as the mantra goes, you make money when you buy stocks, not when you sell them. So let me tell you what the very best moment is to buy a stock. First, you generate investment ideas, like we discussed in lesson 15. Then you put these ideas through a thorough fundamental and qualitative analysis process, like we discussed in lesson 16. Finally, if you are convinced you are looking at a profitable and financially healthy company, you estimate the intrinsic value of this company using conservative inputs and several valuation models simultaneously, like we discussed in lesson 8. Now you compare your intrinsic value estimate to the current stock price. You should only invest when there is a significant margin of safety. So, if the current stock price is way below your estimated intrinsic value. If that is the case, then this is the very best moment to buy this stock. At least for now. Because if the stock price declines further, you'll have an even better moment to buy. Now you can buy more of this great company at an even lower price. This is the average down method we discussed in lesson 10. So the way value investors deal with the impossibility of predicting the bottom is by averaging down. This is why you should never purchase a full position in one go, but instead add more and more stocks to your portfolio as prices decline. You will most likely not buy at the bottom, but this is not a problem at all as long as you only buy stocks trading at prices way below your intrinsic value estimate. So first find good companies, then estimate the intrinsic value, and finally, only buy at a significant discount to this intrinsic value. This is the secret recipe of value investing, and if you follow this simple recipe, I can assure you that you will do very, very well for yourself. So now you know when to buy, but when should you sell? Well, actually, Warren Buffett once said that his favorite holding period is forever. He prefers to never sell his stocks, and there are some very good reasons for this. First, in the United States, you don't have to pay taxes over your investment returns until you sell. By not selling, Buffett keeps these deferred taxes invested, which means he earns compounded interest over a larger sum of money. To illustrate, let's look at the following example. Imagine two investors who invested the same amount of money, earn the same annual return, and pay the same tax rate. However, investor A sells its stock each year and therefore pays its taxes annually, while investor B sells everything after 20 years and therefore pays all of its taxes in one go, after 20 years. This leads to a massive $75,000 difference in returns, simply because investor B used a buy and hold strategy. A second reason why Buffett likes to hold stocks for the long run is because this minimizes transaction costs. In an earlier lesson, I already showed you how devastating the effect of transaction costs can be on your returns. Finally, it is very hard to find truly great investment ideas, so you might as well hold on to a wonderful company once you are finally able to buy it at a bargain price. Even though all of the above points are valid, there are definitely some very good reasons to sell your stocks from time to time. 3 good reasons to be precise. First, you should consider selling a stock once its price approaches your intrinsic value estimate. In this case, the stock is now fairly valued and therefore its upside is limited and its margin of safety gone. Holding on to a stock in the hope the price will move beyond your intrinsic value is speculation and should therefore be avoided. It is very important though not to anchor to your original estimate of the intrinsic value, because while the price was rising, the intrinsic value of the company might have also increased. So always recalculate the intrinsic value before deciding to sell. Second, if you made a mistake and new information blows a hole in your investment thesis, this would be a good reason to sell. Due to confirmation bias, which we discussed in lesson 6, you might be tempted to rewrite your investment thesis in order to make it fit this new reality. Do not do this. Acknowledge you made a mistake. It happens to the best. Just sell and move on. Keep in mind that you don't have to earn it back the same way you lost it. Be careful not to sell just because the price is dropping. Only sell if the company starts to experience fundamental problems which are permanent in nature. Finally, if a better investment opportunity presents itself, this would be a good reason to sell some of your stocks and invest the money in this better opportunity instead. For example, if you own a stock which you believe has an upside potential of 20%, and you find another stock which has an upside potential of 50%, you might be better off selling the former and investing the money in the latter. To summarize, timing the market is impossible because short-term price movements are irrational and unpredictable. You don't have to know when a stock has hit its bottom, you can simply average down. You should never purchase a full position in one go, but instead add more and more stocks to your portfolio as prices decline. Buy when you find a good company selling at a significant discount to intrinsic value. This is the secret recipe of value investing. Holding on to stocks for the long term has many benefits. That's why Warren Buffett's favorite holding period is forever. There are only 3 good reasons to sell a stock. Sell when a stock reaches its intrinsic value. Sell when you made a mistake. And sell when a better investment opportunity presents itself. Okay, you just finished the second to last lesson of this value investing video course. Give yourself a round of applause for making it this far. To wrap things up, the final lesson will explain how you can maintain and manage a healthy stock portfolio.